We're now going to look at the primary market. That is, how companies create and sell shares. We'll be looking at IPOs in more detail, as well as other ways of creating new shares. As we know, the primary market is the creation and sale of new shares, so let's have a look at the different ways in which these shares can be issued to the public. When a company decides that it wants to raise money by issuing shares to the public for the first time, it will make an initial public offering, or IPO. This is also known as coming to the market or flotation. Before the IPO takes place, a prospectus containing all the relevant information will be issued, with details on how many shares there are, who the directors are, their history, and so on. Any investor looking to buy shares in an IPO can request a copy of this. When one company buys another company, it can pay partly or entirely in its own shares rather than cash. These new shares are issued to the owners of the company that is being bought and are known as vendor shares. Directors and other key executives may be awarded share options, meaning that they have the right to buy a set number of shares at a set price. Buying shares in this way is called exercising the options. There are other occasions when companies already listed on the stock market may create more shares. We'll look in more detail at these later on, including the implications for shareholders and what action needs to be taken in each case. Shares can be cancelled as well as created. When a company is taken over, the new owners usually buy all the shares from the existing owners and scrap the lot. When a company is doing really badly and the share price falls heavily to the point where the shares are practically worthless, a share consolidation may take place when most of the shares are cancelled. Say the consolidation is one share to replace every 10 you already own. The hope is that the one share you own will now be priced at 10 times as much as each of the shares you previously held. Occasionally, a company may buy its own shares cheaply in the hope of reissuing them later at a higher price. While these shares are held in abeyance, they are known as Treasury Shares. For the most part, though, if you're investing in the stock market, you will be buying shares on the secondary market, that is, buying existing shares second-hand. The cash you pay for these shares does not go to the company, but instead goes to the person who already owns the shares. When you sell any shares you own, the proceeds of the sale come to you, not to the company.